Monday, September 18th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at whether financialization and the end of the everything bubble are around the corner. And we're going to look at a particular symptom of the everything bubble, and that's stock buybacks. And I'm going to reference this book, which I was reading this weekend. I haven't finished it, and it was talking just about that. And a recent article that just came out, I think yesterday, in the FT, that goes to show that we could be at the end of an era of financialization. And I'm going to try to tell you what I think the impact of that would be. I've got Rudy here today, just for him to say hello to you guys. He's getting a bit fluffy. He's got his groomer coming tomorrow, right, Rudy? And he didn't want to go on the sofa. He wants to go under the desk today, so I'm going to put him back down. That's where he likes to go. It's like a little cubby hole or a kennel. He feels comfortable in there. So before we look into stock buybacks, low interest rates, financialization, we're going to look at what's going on in the world of precious metals, especially gold and silver, and the situation in China or Shanghai. Well, I think the premium, Shanghai premium is around 5%, so it hasn't gone up that much more. But one thing I saw here from Bai Xiaojun is that the People's Bank of China, they've increased their gold holdings. I think they've done it every month this year, and they started publicizing it last year. So according to him, the People's Bank of China released gold reserve data for August, increasing gold reserves by 930,000 ounces, equivalent to 28.926 tons, with a total reserve of 69.62 million ounces. That's the official reserves, of course. Just for the People's Bank of China, that corresponds to just under 2,200 tons, as you can see there. I think that's significant. Up until late last year, the Bank of China would only update their holdings about every 3 years. Now they're doing it every month. They're continuing to purchase, and I think that's not going to stop. And of course, we've been talking about gold and silver here since the beginning of this channel. And why? Well, because when I first bought gold in 2002, as a diversification for my pension investment, I bought Krugerrands, real gold. You start looking into it. you get an interest, and looking at gold for me opened my eyes to the fraudulent, unsustainable nature of our current fiat currency system. And of course, many of you have asked me over the years where you can get gold. And yes, I've got a few affiliates. I've had gold investments for the last five years or so. And recently, in the last year or so, year and a half or so, I've partnered with Miles Franklin in the US and also ITM Trading. And I'm also affiliated with Glint, which allows you to buy gold and store it in Switzerland in a segregated account, and at the same time have an app and a MasterCard to spend that gold. So if you want to find out more, go to the description of this video. All the details are there. So back to the everything bubble, and that has everything to do with this fraudulent nature of our system, or not even fraudulent. It just allows the banking sector, the central banks, government, to push interest rates ever lower, and they did that. They used, of course, the cyclical trend or secular trend that was going that way, I have to admit. Interest rates topped back in early 1980s, but ever since the early 2000s, central bankers under the leadership of Alan Greenspan at first and then Bernanke, they've pushed interest rates lower through QE. The Bank of Japan, of course, was a pioneer in that. They started before everyone else. And yes, it's created an environment of financialization. And what does that mean? Well, I'm going to reference this book here, The Price of Time by Edward Chancellor, which I highly recommend. And I was reading about this book this past weekend, and he was talking about the promoter's profit, and this is not the first time this has happened. Back in the late 1800s, there was a period of very low interest rates. Yes, there was no Federal Reserve, but the U.S. Treasury and Wall Street, they pushed interest rates very low, and that helped create the robber barons, the big trusts. And why is that? Well, because very low interest rates promote speculation, financial engineering, and I think that's what we've had. So in terms of buybacks, this is what the author says here on page 163. So I'm going to go through this. It says, the great management consultant Peter Drucker once wrote that profits were not the rationale of business decisions, but rather the test of their efficacy. What Drucker meant was that if a company does its job well, delivering goods or services for customers at competitive prices, then profits should be forthcoming. From the early 1980s onwards, however, the corporation's purpose was redefined. It was no longer about serving customers or even making profits. Instead, companies were told to pursue shareholder value, a management philosophy aiming at maximizing the market value of the company's equity. In the name of shareholder value, senior executives were handed free stock options and other equity-linked incentives. Now they had skin in the game. Management interests were said to be aligned with those of shareholders. Under President Roosevelt's New Deal, it was made illegal for companies to acquire their share in the market, this being regarded as a form of stock manipulation. But this law was repealed in 1982 at around the date when interest rates embarked on their multi-decade decline. Under the mantra of shareholder value, management were encouraged to replace expensive equity with cheap debt. As long as the cost of borrowing was low enough, executives could boost their company's earnings by purchasing their shares with that. Since companies with robust earnings growth performed well in the stock market, senior executives earned windfall gains from the simple feat of financial engineering. The promoter's profit was back. So he's written here, it's in a box about buybacks, how the game works. We're going to go over it. I'm going to try to go over it as quickly as possible to give you an idea what this social engineering is all about, or financial engineering, I'm sorry. So buybacks, how the game works. Imagine a company, let's call it FinEg Corp, Financial Engineering Corp, with sales of $1 billion and a 5% profit margin. The $50 million of profits are taxed at 30% rate. The company has 500 million shares outstanding and shareholders' equity of 500 million. The shares trade at 15 times earnings. The corporate incentive plan provides senior executives with 50 million stock options, which strike at the current market price. At this point, FinEg has no debt. Given these details, we know that the company's post-tax profits are 35 million and its return on equity is 7%. The earnings per share are 7 cents, 35 million divided by 500 million. That's how you get the 7%. On a multiple of 15, the shares trade at $1.05. The company's market capitalization is $525 million. Management now decides to use leverage to repurchase half its outstanding shares. To keep things simple, let's assume the buyback occurs at the current market price. FinEgg borrows just over $260 million at 5%. Given that interest payments are tax deductible, the effective interest cost is around $9 million. After interest costs, post-tax profits are reduced to less than $26 million. That doesn't sound too good. The impact on earnings per share, EPS, is very positive, however. Post-tax profits of $26 million divided by half as many shares produce 10.3 cents EPS, or earnings per share, an increase of nearly 50%. Given that investors appreciate EPS growth, the stock is re-rated to 17.5 times earnings. As a result, the share price climbs above $1.80, up more than 70%, and the shares are now trading at a substantial premium to book value. The value of executive stock options increased by more than $35 million. Although the chief executive has not developed any new products, increased investment, or done anything else to improve the company's long-term prospects, she shares in this bonanza. And why not? FinEgg's return on equity has climbed to 10%, up 3 points. Given that the company is still not highly leveraged, the Fed is keeping interest rates low, and credit spreads are tight, the board of directors decides to authorize another large buyback and rewards its high-performing CEO and another grant of stock options. The numbers in the FinEgg case study are hard to follow for anyone unfamiliar with corporate finance, but the important point is that the use of low-cost debt to repurchase shares artificially boosts profitability and stock valuations. Given that executive compensation is generally linked to measures that are enhanced by financial engineering, such as returns on equity, EPS growth, and stock performance, senior management has a strong incentive to play the game. Short-term investors, bankers, and senior corporate executives benefit from this financial engineering, but no one else is better off. So I'm going to stop here. He goes on to talk about the financialization curse, and then the next chapter, of course, is about the big, fat, ugly bubble, the central bank bubble, the everything bubble. And why do I think this could be in peril, this buyback craze? And the other thing he goes on about is how it zombifies the economy, all this cheap debt, because it allows companies that shouldn't be around to stay running, and it actually crowds out good companies from financing their operations. Well, it's interesting that I read that part in the book, and then yesterday this story came out in the FT. Yes, it was from yesterday, published in New York from Nicholas McGaw in the FT, and it says companies ease off on share buybacks as rising interest rates push up costs. Growing pressure to invest in regional banking turmoil also deterred companies from purchasing their own shares. So, yeah, it goes through the fact that it's a controversial thing, the share buybacks, that it kind of manipulates how well the company's really doing. It makes the CEOs and the higher echelons of management focus on just the stock performance, and they use a lot of their profits to buy back shares, or they borrow to buy back shares, and they don't really invest in the company or invest in new products. And I think that's what we've been seeing with this everything bubble. And I think we could be on the cusp of it blowing up. And what would be the consequences? As I said earlier in the beginning of the video, I said I try to tell you what I think the consequences will be. Well, the consequences I think will be to rebalance wealth from this everything bubble, from these valuations that are not really real. The only reason they've been able to inflate this everything bubble is because the central banks, of course, they've kept up until recent interest rates artificially low, not just from like 08, 09, but even before that in the early 2000s with Greenspan and Bernanke saving the system every time there is a problem. And that gave investors and speculators the signal that they would always be there, the Greenspan put. And now that's all reversing. And why is it reversing? Well, there's a lot of factors involved. The fact that the 40-year bull market in bonds could be ending. There's no way that they can stop that. It's something cyclical in nature. There's also deglobalization after 2020. A lot of interesting things, but one big thing I would say is that nothing lasts forever. Nothing is sustainable. This game of financial engineering. And so I think it will revalue sectors of the market, the sectors that have benefited the most, the big corporate interests, the big corporations, tech, real estate. They're going to suffer relative to real things like commodities and precious metals, because you haven't had to worry about the real world. You've had all these artificial low interest rates. And it's interesting, though, that the author talks about how productivity has fallen as well, especially since 08. And the central banks, they've published a lot of papers talking about this, wondering why, but they never really look at themselves in the mirror and realize that their policy of artificial low interest rates are a big part of this problem. And that's why I think we could be on the cusp of this everything bubble, or the central bank bubble, unraveling. And in my live stream yesterday with Rafi, I spoke about the fact that there's a new survey out over the weekend, and a lot of economists now don't expect the Fed to pause this week. I think their decisions on Wednesday. They expect another 2 hikes, and that they're going to keep interest rates higher for longer. And I think they're right. And the people who think when we get a recession that we're going to see bond yields drop again like they used to, I think they're going to be proven wrong. So there you go. Highly recommend the book, The Price of Time, Edward Chancellor. So with that, now let's quickly look at the markets this morning. It's 8:25 a.m. London time. So we got spot gold trading at 1928.50, is up about $5. The high's been 1931. The low has been 1921. Silver's trading at 23.16. It's up 13 cents or 0.5%. High's been 26. The low has been 23.00. The Dow futures is up 35. NASDAQ 100 futures up 24. S&P is up 6. To the currencies, sterling is unchanged, 123.88. The euro as well, unchanged, 106.62. The dollar is down about 0.2% versus the yen, 147.60. And the dollar is up 0.2 versus the yuan at 7.29. Let's check the ruble out. Well, the dollar is up 0.2%, trading at 97. The Aussie dollar is up 0.25% at 64.44. The dollar is down 0.2 versus the Canadian dollar. It's testing 135. And the Kiwi dollar is up 0.2 at 59.10. To the commodities, we got WTI crude up 0.2%, trading at 90.75. Brent is up 0.5%, trading just below 94. Platinum is up $7, trading around 935. And high-grade copper is up 0.5%, trading at 382. And to the bond market, really important, looking at yields. And I said yesterday in the live stream that we had the highest weekly close in 16 years for the 10-year yield. It closed just above 433. Right now we're at just below 4.35. It's up another 2 basis points. So with that, I'm going to wish you all a very good start to the week and a great day. Take care. Bye.